Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Market bounce. A rumor triggers a 7-minute, $2.5 trillion rally on U.S. equities. Investors left on edge by clashing tariff comments in the search for clarity. Asian stocks lead today's session higher after their worst day on record. Fight to the end. China slams the U.S. for threatening to further raise tariffs and threatens its own retaliation. In the meantime, the PBOC takes the yuan fixing above 7.20 for the first time since 2023, pushing the offshore yuan higher. And direct talks. President Trump says the U.S. has started direct negotiations with Iran, with the next round set for Saturday. Tehran has rejected the idea, proposing Oman as a mediator. Well, it's just gone 8 a.m. across the Emirates. I'm Johannesburg in Dubai. Still reeling from the price action yesterday. No way to describe it, but a roller coaster session once again for U.S. and global stock markets. And what we got was a lot of up and down action. Throughout the course of the afternoon, this unconfirmed report came out suggesting that the Trump administration was considering a delay in terms of the imposition of those reciprocal tariffs. That lasted for 7 minutes. White House came out and said that that wasn't on the table. But by then, you had already seen a bit of a rebound in equities. And then later on in the session, the White House administration also saying that they were considering an extra 50% levy on Chinese goods. So all of that happening just in the last 24 hours. But what it has meant is there's been a bit of stabilization come through in these markets. As you can see behind me, S&P now, futures leaning towards the green, up 1.5%. We closed marginally in the red yesterday, down about 0.3%, still down 9% since the tariff announcement last week, and very close to bear market territory, bear market being a pullback of almost 20% from the peak. So S&P still very much negative on the year, but today things are stabilizing. Similar theme for NASDAQ, some green on the board today, up 1.2%. And then take a look at European markets as well, leaning towards the green, up 2.4%. This after a very negative close yesterday. Euro stocks closing down 5%. But then, of course, with the stabilization in U.S. equities, we're seeing that pan out into European markets this morning. And then look at this. The Nikkei today up 5.3%. You may be asking why? What has happened here? Well, the door has been opened to direct negotiations between Japan and U.S. vis-a-vis getting to some solution on these tariffs and the tariff rates. With the Treasury Secretary Scott Bessent saying that Japan have now moved up to the top of the list. So you're seeing a positive reaction in the Nikkei on back of that, on some hope that where they end up with tariffs is a lot lower than what was put forward last week. Other assets. So VIX, massive bounce yesterday, given all of the volatility in stock markets. We're now back to 47. At one point, we got to 60, levels not reached since last year around the volatility shakeout in August, but still very high levels for the VIX now, 47%. Brent, you can see, again, some more positivity coming through today, 1.4%. We're back up at $65, but we're still down about 12% in the last couple of trading sessions. Why do I have dollar yuan fixing up here? Well, for the third day in the row, PBOC have allowed this fix to come in higher than 7.2. Why is that relevant? Because markets are saying that one tool that China have to push back and to counter the impact of tariffs is a weakening of their currency, a forced weakening of their currency. This is the reaction in offshore renminbi today. So it's trading a little bit weaker versus the USD. And then 10-year yields, really surprising price action yesterday in yields, because even though we had so much volatility, risk-off sentiment, concerns about where global growth is headed, U.S. Treasuries sold off. We moved up about 25 basis points. That switched the board. I'm keeping a close eye on what's been happening to the shape of the U.S. curve. 2s10s. This is a chart of the difference between the 10-year yield and 2-year yield. It keeps steepening. What does this tell you? Investors are pricing in a faster interest rate cutting cycle in the front end of the curve, but further out, once more, we're seeing some concerns rise, and that could be on back of a fiscal premium, on back of a policy uncertainty, and even investors wanting to move away from dollar assets. So this is what's happening with the shape of the U.S. 2s10s curve, something to bear in mind. But let's get back to that top story. It's about tariffs, as ever. President Donald Trump says he is not considering a pause in his plan to implement sweeping tariffs, but is open to negotiations.
Open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs.
For more, let's bring in Bloomberg's Derek Wallbank. Well, there is so much noise, Derek, but our job is to figure out the signal from the noise and what President Trump wants to get out of this. And it seems as though in the last 24 hours, a little window has been opened to negotiations and to ultimately bringing down some of these tariff rates for key trading partners. So, and you probably heard me talking about the price action in the Nikkei today. That is a direct reaction to the fact that the U.S. administration is saying that Japan are on the priority list in terms of getting a deal done.
Yeah, and it remains to be seen exactly what this priority list means in practice. Look, Jemana, I think we have seen a lot in the last 24 hours, as you quite rightly mentioned, reflecting sentiment trade, right? The idea that that if we see something that suggests that Trump may do something different between now and 12:01 a.m. Washington time on April 9th, that insert thing here will happen, right? But it's not really clear what Trump might do, and it's not really clear that any of those things may happen at all. The example that I would point to is Israel. If Japan is in a priority consideration, Israel is absolutely at the front of the line. Benjamin Netanyahu went to the White House to talk about trade. That was specifically the agenda. He met with top leaders. Israel had already pulled off trade restrictions against U.S. goods, and it got them precisely nowhere yet. They are still set for a 17% levy. And that, I think, is sort of an object lesson here. We do get some of these sort of hope and change kind of symbols. But what we're really looking for, what I think the real clarity is going to come on, is when the White House delivers the very first sense that this is the particular package that can move this president, and here are the levels that he's willing to move to. So far, we haven't seen that.
Yeah. Yeah, but also, Derek, it speaks to the very differing approach that countries around the world are taking with the Trump administration. China are fighting back. Netanyahu went all the way to the White House to get a deal with President Trump. EU are sort of laying low. What does this tell us about where we may eventually end up? Because it isn't going to be a magic wand that's just going to remove all of these trade barriers and tariff rates. We may end up in a situation where it differs from country to country based on a relationship or a bilateral relationship that the president has with that leader of the leader of that bloc or the leader of that nation.
You're so right to highlight this. I think it's a manifestation of the fact that countries don't actually know what's going to move the White House. Some of them are trying carrots, some of them are trying sticks, some of them are trying both, frankly. And that's countries as well as regional blocs. You know, we've gotten the European Union saying that they want to move kind of together. We've seen ASEAN here in Southeast Asia talk about keeping in touch and having some amount of collaboration. Who knows what that'll exactly look like, but sort of keeping in touch as they move together. And that is some of the hardest hit economies by Trump's potential sanctions in terms of per country tariff volume. So you're really talking about a range of options. Now, I was struck by the Chinese comment. Not only has China put forward 34% reciprocal tariffs to Trump's own trade deficit calculated reciprocal tariffs, but China has said that it's willing to do what's necessary and continue to fight as far as it needs to. You have seen some moves from Europe talking about pushing back maybe a little bit harder. So far, we haven't seen that quite come to the fore. But I would go back to the very first thing that we talked about, that fake headline which didn't actually have truth behind it, that sort of cropped up out of the ether. The move on that was so dramatic that it really does show you a pricing level for what would happen if there were an actual, Bloomberg grade red headline that were to run, that were to provide an actual amount of clarity here, right? There really is a big gap between where we are and where we could be, both on the upside but also on the downside, because as you quite rightly noted to start this segment, we have seen some rally based on this idea of hope and a path forward, even if we don't quite know where that path leads.
Yeah. Yeah, exactly. There's the idea of hope, which is something that didn't exist, I guess, 24 hours ago. Bloomberg's Derek Wallbank, always good to talk to you. To bring in, to further the conversation, let's bring in Sree Kochugovindan, Senior Research Economist at Aberdeen Investments. Really good to have you with us.
Thank you.
I want to bring up some comments that Larry Fink made in a conversation with our colleague Eric Schatzker yesterday at the Economic Club in New York, and he told the room that most CEOs he talks to say we're in a recession already. The canary is sick. Do you think a recession is on the cards for the U.S. now?
I think what we're seeing is the tariffs as they stand. Tariffs are a tax on the consumer. So this is a big threat to the growth picture, the growth backdrop that we had seen. So far, the hard data had been quite resilient. Balance sheets for households and corporates still quite strong. But the surveys, as you say, exactly what Larry Fink was saying, surveys, the uncertainty that's there is really impacting decisions for investment, hiring, going forward. And that's really being reflected here.
You know, markets were pretty hopeful that the Fed were going to step in and provide some support to the market. But over the weekend, Powell sort of batted away people's hopes that that was going to happen imminently. But equally, they can't act until the soft data starts the hard data starts reacting to the weaker survey data that's coming through. How long is that going to take?
I think that will take a number of weeks, possibly months, for this to really materialize in the hard data. Because, first of all, there's still no clarity in terms of the exact direction of these tariffs. Will the tariffs stick, or are they a negotiation tool? How quickly can these negotiations happen? So I think that this uncertainty period will last into the second half of the year, and then we'll start to see the impact on the economy. And unfortunately, as they stand, if they do stay exactly at these levels, which we're not expecting, they should be negotiated lower for some countries, but they do provide a stagflationary shock, unfortunately. So they do provide, our estimates are potentially 2% on the level of prices on core PCE for going into this next year, and a drag on growth. And that's very difficult for the Fed to navigate. They need to be concerned about inflation, the inflationary impact of tariffs, and then later on in the year they can think about easing.
Yeah, stagflation, it might just be a good old recession if things continue the way they are.
Yes.
How much financial volatility do you think this administration is willing to tolerate?
This is the big unknown. I think the expectation had been that the strike price would be a lot higher than we are now, but it's not clear what the pain threshold is, and the fact that they are sticking quite firm has been a concern. But I think just in the last 24 hours, we've seen some good signs here that they are having bilateral discussions with Japan, with India, with a number of different countries. So I think the most difficult negotiation is likely to be with China. That's where both sides are really digging in their heels. But I think elsewhere there are signs of this lifting. I think Japan's a very interesting example. We've seen the Nikkei rebound, and I think rightly so, because we've had a number of different things. There had been this ongoing story about US steel, Nippon Steel, buying US steel. And I think that's relevant, the fact that there's a bit of a shift on that side, because previously the Biden administration had banned this, and I think that had been an issue about US jobs. Yeah, well, I was remarking on this to my colleagues earlier today, and I was saying it is a bit ironic, right? Because Trump administration are saying that they want to bring back manufacturing jobs to the U.S., but at the same time, they've reopened the possibility of Nippon Steel acquiring U.S. steel. And the reason they pushed back in the first place is because they were concerned it was jeopardizing U.S. jobs. And so is this about the ideology of preserving jobs in the U.S., or is it simply about cutting deals with trade nations? I think it's a combination of the two. With that steel example there, Japan, a number of different companies have insisted that actually Japan is a net employer. They do provide a lot of jobs. They have located a lot of factories in the US, and that's something that they're willing to continue to do. So it's not necessarily a threat to US jobs to have that deal go through. If anything, it could protect that company.
Yeah, so interesting. Sree, great to have you on. Thank you for sharing your perspectives and helping us to make sense of some of these headlines that are coming through. Sree Kochugovindan, a Senior Research Economist at Aberdeen Investments. Up next, President Donald Trump says the U.S. will be holding direct talks with Iran. The details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Bersachi in Dubai. President Donald Trump says the U.S. is holding direct talks with Iran, and the next round will take place this Saturday. Trump says the talks will be at what he described at almost the highest level. But leaders in Tehran have rejected this idea and proposed negotiations with Oman as a mediator.
We're having direct talks with Iran, and they've started. It'll go on Saturday. We have a very big meeting, and we'll see what can happen. And I think everybody agrees that doing a deal would be preferable to doing the obvious.
Joining me now is Paul Wallace, who leads our MENA economy and government coverage. Well, while the whole world has been following the tariffs ins and outs, the Trump administration now is also setting their eyes on getting a deal done with Iran. Those comments are really interesting yesterday on the back of that conversation with the Israeli Prime Minister Netanyahu. What do we know about these potential discussions that will take place between the U.S. and Iran?
Yes, very interesting. And these have sort of come out of the blue. Obviously, tensions between Iran and the U.S. have been ratcheting up, and Trump has been threatening military action if Iran doesn't come to the negotiating table. But we didn't sort of see these talks. Whether they're indirect or direct, it's a little bit unclear. Iran is saying they'll be indirect. But either way, this is a pretty big move on the face of it. Iran is saying the talks will involve its Foreign Minister Araghchi and Steve Witkoff, who is obviously very close to Donald Trump, and he's Donald Trump's main Middle East envoy. So that is very much at the sort of high level that Trump was talking about. It's unclear, whatever happens on Saturday, I think these talks are going to go on for a long time if we're to get a deal that's in any way comprehensive, that in any way curbs Iran's nuclear activities, let alone its, its support of militia proxies.
I mean, it's probably too early to say this, but it's ironic because it was President Trump who pulled out of the JCPOA deal, and now many years later, we're 7 years later, he's looking to restart and enter into a deal that would limit Iran's nuclear activity. That's exactly what JCPOA was, wasn't it?
Exactly. I mean, the JCPOA didn't address things like Iran's support of groups like Hamas and Hezbollah and its ballistic missile or its missile program, which was one of the things that Trump and Israel and others said was a huge flaw. Maybe Trump will try and get those things included this time, but you mentioned Trump pulling out in 2018. It's hard to sort of overstate how important that is, because for Iran, that is a huge source of, or huge reason they distrust Trump.
And Paul, did we get anything on Gaza and the situation in Gaza yesterday out of that meeting?
Very little. Gaza was almost a bit of a sideshow versus tariffs and Iran, but it does look like there was no pushback on Israel, stepping up military and military activities and the ground offensive in the Palestinian territory. So it looks like that is going to continue. Yeah,
with 1,300 people killed per the health ministry since March, since the ceasefire collapsed. Paul, thank you so much for the latest. Paul Wallace, who leads our MENA economy and government coverage. Now, coming up, Senator Elizabeth Warren says one person is responsible for the U.S. stock market volatility. I wonder who that might be. That's coming up next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. President Donald Trump's trade war has U.S. stocks on the precipice of their first bear market since 2022. Senator Elizabeth Warren of Massachusetts spoke with Bloomberg's Balance of Power about the market volatility.
I am really worried about whether we are already in a recession or just right on the edge. All of the lights are flashing red. And Larry Fink points this out, but he is not the only one. There are a lot of folks who are starting to say this, and a lot of evidence in that direction. Where our focus should be right now is on preventing it from getting any worse. And we can do that. This isn't some outside shock. This is not some war in some distant land that's caused this problem. This is not that the markets are imploding because suddenly all of the bad mortgages are coming to light, like in 2008, one person has started the dumbest trade war in the history of America. Congress has the power to rein that back in. And if Donald Trump and his team won't do it, then Congress should step up and do it before more damage is done.
Well, does one person also have the power to provide a check on that damage? To get back to Joe's question, Senator, even if the Fed were to issue an emergency rate cut, would that be enough to stem all of the bleeding that you think could be happening in the U.S. economy as a result of these policies?
Look, the Fed chair himself on Friday just said that he is concerned that this haphazard tariff announcement is going to drive up inflation and drive up unemployment simultaneously. You know, I understand why the Fed chair is really worried at this moment. The one person who can stop this problem is Donald Trump. And if he will roll back these tariffs, we can at least stop the damage from continuing to bleed out through our economy and around the world. And if Trump won't do it, then we just need some Republicans in the House and the Senate to grow a backbone and do what they know is right. You know, I don't know anybody in Congress who's saying, man, this is a great idea. What a cool move. They are really worried about what's happening. They're hearing it from their own constituents at home. But they have the power to fix it. So let's put the pressure on those Republicans to join with the Democrats and take away the authority from Donald Trump to be able to continue to roll out a tariff policy that has the potential now to put millions of people out of work, cost millions of people their savings, their retirement, and start shutting down businesses throughout this country.
Senator Elizabeth Warren of Massachusetts speaking with Bloomberg's Balance of Power there. Now, let's take a look at how equity futures are faring. Some stabilization coming through today. It's weird to see green on the screen, but there you have it. S&P futures up 1.3%. European futures also leaning towards positive, up 2.1% after quite a negative close yesterday for the European stock markets, down 4.5%. But we are seeing some cautious optimism come through in the early hours of trade. Now, coming up, we continue to track market moves following China's vow to fight to the end if the U.S. insists on enforcing new tariffs. This is Bloomberg. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Market bounce. A rumor triggers a 7-minute, $2.5 trillion rally on U.S. equities. Investors left on edge by clashing tariff comments in the search for clarity. Asian stocks lead today's session higher after their worst day on record. Fight to the end. China slams the U.S. for threatening to further raise tariffs and threatens its own retaliation. Meantime, the PBOC takes the yuan fix above 7.20 for the first time since 2023, pushing the offshore yuan higher. And direct talks. President Trump says the U.S. has started direct negotiations with Iran, with the next round set for Saturday. Tehran has rejected the idea, proposing Oman as a mediator. Well, it's just gone 8:30 a.m. across the Emirates. I'm Jumana Versace in Dubai. You heard that in the headlines. Asian stocks had their worst day ever yesterday, ever on records, even worse than what we had in GFC and throughout COVID. So that just really shows you how much of a wild ride we saw for stocks yesterday. And despite all of that, we had the S&P closing just moderately lower, about 0.3% weaker. This on unconfirmed reports that the Trump administration was considering delaying the implementation of those reciprocal tariffs. That was later denied by the Trump administration, but it was enough to sort of keep market optimism and bring on market optimism back. So what you're seeing today is some green actually on the screen. S&P futures up 1.3%, Nasdaq up 1.1%. Still, S&P very close to bear market territory, i.e. a 20% pullback from the most recent peak. Just to give you more numbers, $10 trillion in market cap has been wiped out since tariff day last week. European markets also leaning towards the green today, up 2%. And take a look at the Nikkei, 5% higher today. Why? Because direct talks are now taking place between the U.S. administration and Japanese officials vis-a-vis tariffs and reducing the reciprocal tariff rate that will be applied on Japanese goods. So they are at the top of the queue per Treasury Secretary Scott Bessent, and that is why you're seeing this reaction in the Japanese stock market today. As for other asset classes, let's go through these fairly quickly. VIX, obviously so much volatility in the market. So we saw this shoot up yesterday. We got to about 60%, now down to 47%. But again, a massive spike indicating that investors are still nervous about the direction that S&P can move in on any given day, pricing in a daily move of more than 2.1% right now. Brent recovering a bit this morning. $65 is where we're at, up 1.4%. So again, some stabilization coming through, even though we're down double digits in the last couple of trading sessions. Dollar renminbi, why are we talking about this? The fix came higher than 7.20 for the third day in a row. Officials are allowing this currency to slowly depreciate. Relevant, why? Because it is one of the tools that China has to counter the impact that the tariffs will have on the Chinese economy. So keep an eye out for that and its implications on global FX markets as well. And then 10-year yields, massive moves yesterday. We scaled up about 20 basis points higher in both 10-year yields and 30-year yields, which is very interesting because flip the board. What you are seeing right now in this environment of risk-off and volatility, typically you'd expect money to be going in to 10-year and 30-year treasuries. That isn't the case. The curve is bull steepening, i.e. the front end of the curve is going lower. Two-year yields are accounting for the fact that the Fed may have to be more aggressive with rate cuts. But further out, 10-year and 30-year, you are seeing yields move higher because of all of these question marks about policy, about credibility, about fiscal premium. And that is why the curve continues to steepen. So something that fixed income investors are paying close attention to, and also that is having an impact on credit markets, as we spoke about yesterday. Now, let's talk about what China's been doing, because they have eased their tight grip on the yuan by weakening the daily reference rate past the keenly watched 7.2 per dollar level amid the escalating trade war with the U.S., as we were just talking about. Now, the move triggered depreciation in the spot yuan, with the onshore yuan sliding to its weakest level since September and the offshore currency hitting a two-month low. So for more on this, Bloomberg's executive editor for Asian markets, Paul Dobson, joins me now. Paul, talk us through the significance of what's happening with the Chinese yuan right now.
Yeah, hi, good morning. That 7.2 level that you've been talking about is quite a significant marker, at least on a psychological basis, because it had been seen as a level that China was unwilling to allow the currency to breach and had in fact, remained that way since Trump came into office. So people are reading into this the idea that at the very least China is allowing some more flexibility with the exchange rate, would allow it to continue to depreciate depending on market pressures, but also depending on the way that the tariff discussions go from here. The idea being that if China wants to counterbalance some of the impacts of those tariffs, it can achieve that by allowing the yuan to weaken, and that's exactly what we saw the last time that Donald Trump was president, and there was trade tensions and battles going on between China and the US. So what will count, of course, is how much further we see the yuan depreciate beyond that level based on the fix. In the coming days, to get an idea of whether this is going to be more of a continued and sustained depreciation from here, or whether it's just, kind of a little bit more flexibility around the exchange rates.
Paul, what can the authorities do to make sure that this depreciation is still done in an orderly fashion? Because right now, I guess the last thing China wants to see is a disorderly depreciation of the currency. But at the same time, they do want to fight back against these tariffs in any ways, any means that they can. And one tool to do that is the currency. But how can they make sure that it stays orderly?
Yeah, that's right. And that's exactly the conundrum that they face. If they do allow it to weaken too quickly, then the market might start to get into this mindset of thinking, the currency is going to keep on going lower. We need to get out of it sooner rather than later. We're not waiting around to see what happens next. And that could create that kind of capital flight risk that we've seen at various points in the past with the UN exchange rate. What can they do to stop it? One, just allowing the market to go incredibly slowly, which is what we've seen so far with the FX fix, and using tools like state bank purchases to slow any moves the other way, and also, of course, being very clear in the communication about what they want to see the UN doing and how important stability is within that. On the other hand, they may not wish to do that. They may want to create a little bit more of a shock and allow for a shorter, sharper move that really sort of sends a clearer signal. That hasn't been the case so far. That's not what many of the strategists that we speak to are seeing or expecting to happen either, because of that capital flight risk. But if they really wanted to send a message that the currency is in play now, then they could actually, move the other way and allow for that much bigger move. That would be quite a surprise and a shock for the market, I think.
Yeah, it would. Great. Thank you for breaking it down for us. Bloomberg's executive editor for Asian markets, Paul Dobson. Thanks so much. Now, global investors are trying to reprice risk in an age of uncertainty inflamed by dueling U.S. and Chinese visions for the future. President Trump is depicting himself as a national savior who is protecting the American dream with his tariffs. Meanwhile, Chinese President Xi Jinping is seizing the opportunity to portray China as the upholder of global trade rules. And in a headline just crossing Bloomberg right now, the Chinese government has opposed fast fashion giant Shein's plans to shift some production out of China, seeking to prevent a manufacturing exodus due to Trump's tariffs. So much going on here. For more, let's bring in Bloomberg senior reporter James Mager. James, good to have you with us. Look, I think it's no exaggeration to say that U.S.-China relations are clearly getting worse and worse. How damaging could this trade war actually be for the Chinese economy? We were just talking about what Chinese officials are doing to counter the impact, and the currency has been one tool. But what is the main concern about the impact domestically and how these tariffs are going to hit?
I mean, if tariffs go to, Donald Trump's threat yesterday, if that was implemented, would take tariffs announced just in the last 2 months to 104%. Then you add in the tariffs that the Biden administration put on, you add in the tariffs Trump put on in his first administration, you're looking at, the cost of any Chinese export to America would rise, double, basically. So that's going to be, that will decimate bilateral trade between the US and China. And that will be incredibly damaging for Chinese exporters who depend on that trade. The US is about 15% of China's export demand right now, in direct trade. And so if that all disappears, even if it happens over a few years, then those companies, which are already facing weak domestic demand, which are already facing falling prices in China, are going to have to find other consumers to buy those products, or they're going to have to make less. And if they make less, then they fire people in their workforce, they invest less. So, if this actually comes to pass and whatever the things that Donald Trump is threatening happen, it will be incredibly damaging for the Chinese economy. Also because it will damage other countries. Other export markets for China will also be damaged by the U.S. tariffs. If there's a global recession, it's going to make the Chinese economic problems even worse.
Yeah. Just going back to the Shein story, I do think it's interesting that Chinese authorities now, per our own reporting, are trying to discourage Shein from manufacturing outside of China. But the irony about this situation this time around is those other countries that benefited from the first round of tariffs under the first term of the Trump administration are also subject to reciprocal tariffs this time around. It's not like if Vietnam start exporting goods to the U.S., then they can find a way to circumvent all of these tariffs, because Vietnam themselves are now exposed as well. So how does the reaction economically differ this time around from last time around, given so many of these other Southeast Asian economies are also exposed?
I mean, I think there's just massive uncertainty now, on whether those tariffs that have been announced in the last week by the U.S. will all be in place in 3 months' time or 6 months' time. I think it's more likely that at least some of the tariffs are announced in China will be in place, but there may be some opportunity for countries like Vietnam or Malaysia or Singapore and Thailand to negotiate some kind of deal, which reduces the tariff that's been announced on them for some kind of quid pro quo, and will then make them again a better place to have production for export to the US. And so, I think that's much less likely with China. I think the negotiations with China are going to take a lot longer. But it's possible that the Trump tariff trade that we saw in the first trade war, where, as you said, companies like Shein and other Chinese companies and foreign companies moved their production from China to other places to avoid the U.S. tariffs, will continue. But right now, no one knows what it's going to look like next week, let alone next month or next year. So I think all of those investments are on hold. But obviously, Shein was trying to circumvent U.S. tariffs or the threat of U.S. tariffs by moving their production overseas to Vietnam, to other places, and the Chinese government, its view of that is that's damaging for their economy, it's damaging for jobs domestically, and they would like them to stop doing that.
Yeah, very clear. James Mager, Bloomberg senior reporter, thank you. Well, let's continue the conversation now, all things China. Joining us is Jeff Ng, head of Asia Macro Strategy at Sumitomo Mitsui Banking Corp. There were lots of headlines yesterday coming through about the tariffs. And then later on in the session, we found out that the Trump administration, or Trump himself, is floating the idea of another 50% tariffs on China. That would take the total tariff rate to more than 100%. Who knows if that's actually going to come into fruition. But what I think is really interesting is China are fighting back, and they're fighting back not just by introducing their own reciprocal tariffs on U.S. goods, but also by imposing export restrictions, antitrust investigations, and a whole other bunch of verticals. Why does China have the confidence to fight back so hard, do you think?
Well, thanks for having me. I think that over the past 8 years, China has had the experience of Trump 1.0, and then at the same time, they have prepared for this upcoming tariff war, perhaps thinking about the various scenarios that could come in. So this is likely one of the worst case scenarios, and China has really possibly planned ahead. And I think at the same time, what we're also watching out for is a really broad tariff on many other economies. So perhaps China's optimism stems from the fact that many other economies are affected this time around compared to the first round of the US-China trade war, where perhaps it's a bit more bilateral. And possibly with all these sort of like tariffs floating around, it could really damage the US economy much more than the previous one.
So I want to ask you about the financial weapons that they have. Earlier on in the show, we were talking about what has been happening with the currency fix and the fact that the PBOC has allowed the fixing to drift above 7.20. Do you think this is significant? And do you think they're going to continue to pursue an orderly depreciation of the yuan?
I think it's significant because the fixing hasn't been above 7.20, and I think it's showing a signal over the past few sessions that they are fixing almost like one basis point every time, one big figure every time, and that's likely to indicate an orderly sort of like allowance of some currency weakness. I think going forward, we are likely to see a combination of both monetary policy measures as well as fiscal policy measures. So that may also include some of the interest rate cuts to support the economic growth, alongside some weakness in the currency, as they allow for some orderly adjustments of the currency to deal with this trade war.
What about the nuclear option? Would there ever be a scenario where China starts selling their U.S. Treasury holdings?
Well, I think China, on their part, may also want to still maintain some international financial stability. Right now, markets are really looking quite volatile at this stage. So I think while China is planning for some potential responses against US tariffs, but I think they will also want to consider the fact that they do not want to cause the volatility to spike up even further. I think the focus now is on ensuring that they respond appropriately rather than excessively.
Yeah. What about the impact on other countries? Our colleague now was just walking through this set of tariffs and the fact that other Southeast Asian economies are not immune. But then that headline came out saying that Vietnam have now reached out to the U.S. and are looking for a deal. Where do you think we end up on this? And do you think the ultimate net impact is still going to be a negative for these Southeast Asian economies?
Yeah, I think this time around it could be that the smaller Southeast Asian economies are hurt relatively more. After all, the US is still the #1 economy, and China is also a sizable #2. In terms of the GDP size, they do have large domestic economies to cushion any external fallout. Southeast Asia, Vietnam, for instance, is very dependent on trade with trade to GDP ratio of almost 100%. So, any huge fallout, both directly from exports to the US or from some global slowdown, global recession, can really dampen the fragile economic growth that we have seen so far over the past few years. And I think the Southeast Asian economies are trying to negotiate more, but of course the terms will also be quite key to watch for, because any unfavorable terms may also mean that the Southeast Asian economies may see more harm than benefit.
Makes sense. Really good to have you on the show today, and that sort of rounds up our China segment. Jeff Ng, Head of Asia Macro Strategy at Sumitomo Mitsui Banking Corp. Thank you so much. Now, coming up, as South African stocks outperformed its EM peers, we discuss the tariff effects on the continent and specifically South Africa next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Well, South African stocks outperformed EM peers as global markets reacted negatively to President Trump's tariff announcement. Bloomberg's chief Africa correspondent Jennifer Zabazaja joins us for more. Well, we've been keeping track of the moves all around the world. Global markets are reeling from this tariff announcement. And of course, emerging markets also caught in the mix, seeing its worst day since 2008 yesterday. Just walk us through the price action, Jen. What are you seeing?
Right, Jumana, and that coming actually when we were on air yesterday. So it was interesting to take a look at some of the moves that we did see on Monday, especially because, as I heard you were noting before, we did get that initial rumor potentially that tariffs were going to look different, but we didn't actually see that panning out. And yet, if we do take a look at the Johannesburg Stock Exchange, as you can see just there, actually performing stronger, ending the day in the green compared to the MSCI EM index for equities. I was just taking a look at it right now. We are still seeing some downside for the MSCI EM index, but let's just dig into what we did see from the Johannesburg Stock Exchange, because it has been quite volatile for riskier assets, as you were just noting there. We did see a stronger close, up more than 2%, I think is what I saw. Yeah, closing just over 2.7% to end the day on Monday. A lot of that was due to the banking sector, actually seeing Standard Bank, which is the biggest bank in Africa by assets, leading the banking sector. We also, though, did see, as we can see on the chart there, platinum miners doing quite well. We have Impala there. We noted from our Bloomberg Intelligence analyst suggesting that platinum is actually used for some traders as a hedge when we do see the rand under pressure, which of course we have seen over the past few days or so since we did get that Liberation Day. But Naspers, though, ending in the red. Naspers, of course, carries one of the heaviest weighting on the Johannesburg Stock Exchange, is also exposed to China, and so did actually close down 4.5% there. But let's just dig into currencies, because that's what we're looking at now. The rand has really been under pressure over the past few days, and on Monday it was quite a volatile day for many people, actually seeing the rand drop to its lowest levels against the dollar in more than a year. Right now we're looking at the rand at about 19.449, almost 0.8% there down. Also, we're seeing the rand weakening against the pound. It's not just the tariff policies, there's also the complications of what we're seeing with the coalition government here, and many people are wondering, will we continue to see knock-on effects for currencies more broadly? We don't have enough time right now to dig into it, but there's also the complications of a lot of these countries that are resource rich, and that could be affected by all of the volatility that we're seeing right now. So a lot of price action to dig into, but definitely has been a pretty tricky few days for EM assets.
Yeah, no, most definitely. And as we said, the MSCI Emerging Markets Index dropped almost 8% yesterday. Its worst day since 2008.
Yeah.
And many countries around the continent also experiencing heavy declines in where their bonds are trading. So something to keep an eye on. Bloomberg's Chief Africa Correspondent, Jennifer Zabazaja, thank you so much. Well, more news coming up. We're going to keep you up to speed on how these markets are faring after a brutal day, the last couple of days of trading. We'll be back in a moment here on Horizons Middle East and Africa. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. President Trump has ordered another review of the potential sale of U.S. Steel to Nippon Steel. U.S. Steel shares surged as much as 15% after the announcement, triggering circuit breakers and halting trading briefly. Shares closed higher in New York, though still well below Nippon Steel's $55 a share offer. The order gives a new hope for the deal that was scrapped by then-President Biden over national security concerns. And on the back of that, you are seeing a lot of love for the Nikkei index today. It's up 5% in trading, as are all equity futures. S&P leaning up 1.3%, Euro stocks up 2%. That is it for our show, Horizons Middle East and Africa. I'm Johanna Versace in Dubai. Stay with us for Daybreak Europe.